Hi guys, I welcome you all in today's educational video. The topic of today's video is types of trading days. It's a very important topic, so I request you all to watch till the end, and also please hit the subscribe button if you haven't subscribed to the channel yet so you don't miss any of this important content. I can see that many of you have been watching this channel for the first time. A lot of you are joining in for the first time, and I appreciate all of you who are subscribing to the channel. Please help me spread the channel more and more by sharing it also with your friends and family. And now to today's topic of types of trading days. It's a very important understanding that you are going to get today, and I'm very sure by the end of this video and after you start watching charts on your screens in the live market, you will start understanding the types of trading days that occur, and these trading days occur over and over again. Obviously, I am a Nifty Bank Nifty trader and I do not trade on stocks, so all my teachings are based on Nifty and Bank Nifty alone. But these types of trading days, the types that I'm going to discuss today, they are all universal. Okay, so they should work on any type of structure of price that you're observing. So that means that if you're observing crude oil or say natural gas, that is commodities, or if you're observing currencies, or you're observing stock charts, these types of trading days should stay the same universally. So now let's go to the topic and let's start discussing deeper about this topic. Okay, now I have written a few points here which we will discuss first. Firstly, there are 6 types of market days that we will discuss in this lecture or in this video today. So we will be seeing what type of market days there are, what type of price structure, price forms in such market days, and how you can study these price structures. The next we will see is that these types of price structures are repeatedly seen in the market, but you have to understand that no 2 days are alike or identical. So for instance, now if you see that a market is trending like this, then you will not always see the market trending like this. You might see some sort of fall here and then a trend upwards like this. That will also be a trending day. Or you might see a rise in the market like this and then a massive fall after that. That is also a trending day. A trending day could also be something like this, right down to the bottom side, where the market opens here and closes at the low of the day. Here the market opens here and closes at the high of the day. And the third most important thing is that your ability to make use of this information that I'm sharing, which is so powerful, and that ability is going to depend on your level of understanding of the price charts. So it all depends on how much experience you have in the market so far. What is the experience you carry? Are you a trader who has just come in the market? Are you a trader who is there for about a year now? Are you a trader who's there for a couple of years to 3 years or more than that? That experience is going to be important in understanding or identifying these market days. And most important is your willingness to observe price day in and day out. Don't forget this point. This is the most important point. If you are willing to observe price day in and day out, then your charts are going to start talking to you, and they are going to keep telling you information that you are going to absorb more and more each day, and so it will start giving you quicker and quicker understanding of the market. So you should open your charts, go back and start observing price, start studying price. That study is very important, and that study is going to lay your foundation towards understanding market days as they are happening in the live market. So it's not that today I'm making this video, today you watch it on the Sunday, and from tomorrow immediately from Monday onwards you start to analyze price. It's not going to happen like that. That willingness has to be there, your doggedness will have to be there, and you will have to keep understanding and reading the same price charts over and over again. Not like you're going to read stock charts today. So let's say you choose maybe TCS chart today or Infosys chart today or Airtel chart today, and you keep hopping charts every day, and then someday you just randomly look at Bank Nifty Nifty charts or randomly look at USD INR charts. It's not going to work like that. Your ability to understand is going to depend on what sort of charts you're observing every day and whether you are applying yourself to the same charts and applying the knowledge to the same charts over and over again. Okay, so now we are heading to the number one day, that is the typical day. So what is a typical day? A typical day is a day in which you will be able to see characteristically a wide initial balance. What is a wide initial balance? First thing I will discuss is the initial balance with you today. So the initial balance, and I keep talking about it in every video of mine, right? I keep talking about and discussing about this in every price action analysis video. So to explain it, the initial balance is the first 1 hour high and low. And this is important because the buyers and sellers on that day have set their boundaries depending on the initial balance high and low. So as you can see here, the high is on this line here, 1, 2, 3, 4, 5, 6 and 7, 8, 9, 10, 11, 12. So the first 1 hour high and low will be these. So during a typical day, what happens is the price initially opens with a big boom. It opens with a blast. You can see here that it opened with a blast, right? The price kept falling initially, and then it stabilized and took off from the IBL, that is the first 1 hour low, and then that first 1 hour low or that first 1 hour high were never revisited by price. The price will generally tend to stay sideways after establishing the first 1 hour high and low. The importance of understanding this type of a typical day is that once you see that a wide initial balance has been established, then you should understand that it could be one of two types of days, or maybe one of three types of days. One is a typical day, as you can see here, where price moves like this and then it falls and stays sideways throughout the day, where this high and this low are never touched. Another type of day is the trending day, which will be like this, where the first 1 hour high and low will not matter and the price will keep going up like this. Then the next type of day that can happen is a range bound day, where the market keeps going through and through between the IBH and IBL, where the IBH and IBL will be touched multiple times, and that we will be discussing in subsequent slides. Now the next type of day that you can see is the expanded typical day. What happens on the expanded typical day? On the expanded typical day, you will again see that there is a moderate to wide initial balance. You can see here that this is the first 1 hour high and low. I have marked these two lines here, which are the high and low. Now, how do you differentiate between the typical day and the expanded typical day? So the difference is between the initial balance. So you can see here that the initial balance is not very wide, it is moderate, and after the initial balance is set, you can see here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So this is where the first 1 hour is over, and within the first 1 hour, this is the high and this is the low. This is not a very wide initial balance, it could be a moderate initial balance, but the price tends to stay for us for some time within that zone, and then it tends to break that balance. You can see how big that green candle is. It's a very strong green candle. Why is it so big? Because this is the swing high and this is the swing low. There are buyers sitting here and sellers are sitting here. So this is the swing high and the swing low that the market has established within the first 1 hour. Now these sellers will have their stop losses sitting here, and stop losses on the high are buy orders. Why? Because they have gone short here, correct? They have pushed price lower. So when they went low, they had stop losses sitting here. And once this big candle closes outside the initial balance high IBH, which is this black line we have marked here. So once price closes outside it, forms a strong green candle. That means that all sellers will now panic, and then you will see a short covering rally. So an expanded typical day could be formed on the upside or to the downside. Okay, it doesn't have to be formed only on the upside. You could see this on the downside also. If this particular low is challenged and broken by a strong red candle, then you can see a movement to the downside like this, where all the buyers will lose their stop losses and there will be a long unwinding there. So that is the expanded typical day. Very simple to understand. The only difference between the typical and the expanded typical day is within the initial balance range. Now we are heading over to the next day, which is the trending day. Now this is a bullish trending day. What happens on a trending day? On a trending day, the market opens here and then it makes a low here, and then it closes at a certain point. And because the open and the close and the high of the day and the low of the day are so wide, this is the low, this is the high, the open and the low and the close and the high will almost be the same very often. And I said almost. So you can see here how the price opened, initially pushed to the low, made the low here, the open was right here, then it closed here. But the open and the low distance is very less, as you can see, and the price has almost closed at the high. The high of the day and the close are very close by, right? That is the typical characteristic of a trend day, here the bullish day. In this example, you can see that the market keeps going up, it forms a wide initial balance, and then it keeps breaking that and it keeps going through it. You can see various characteristics of a trending day. You can see the market just going up like this, or it could also form a wide initial balance like this, wait a while, and then it could break through it also. But this will still qualify as a trending day. Now let's go to the next type of day, which is the trending day to the bearish side or to the downside. You can see how the bulls have given up after the initial 10 minutes. The bulls have pushed the price up higher, but then they all got trapped and then there was a massive fall to the downside. Obviously, the bulls had to close their positions in panic, and this is absolutely panic selling. So this is another trending day where you can see that this is the first 1 hour low, and after this 1 2 3 4 5 6 7 8 9 10 11 and 12. So this becomes the first 1 hour high. Market has broken through the first 1 hour low here, and then it has gone trending. So the trend actually started right here. This is the high from where the trend started, and the market has kept falling continuously. There is no sideways movement and then a break in the market. That is the way in which price falls. So whenever there's a fall, it will keep doing this, where it will keep offloading old traders and onboarding new traders. New short sellers will come into the market and older traders will get out of the market by booking profits. That's why the pullbacks here. So that is the characteristic of a trending day, and you saw two examples now, one of the bullish trending day and one of the bearish trending day. Okay, now we are going over to the next day, which is called the double distribution trend day. What is the characteristic of a double distribution trend day? The double distribution trend day does not have a very wide initial balance. As you can see here, this is the low and somewhere this is the high. So it doesn't really have a very wide initial balance, but it is characterized by a very sideways kind of a movement in the earlier half of the day. Then there is a massive fall, and then there is a sideways movement again afterwards. So the price never really looks to go anywhere in the initial part of the day, and suddenly it forms a trend, and then the trend vanishes and the market again starts to go sideways. So there is no typical movement in the market on such days. So these are called double distribution trend days. Okay, and such days will happen regularly in the market, but you just have to understand that they will not look alike. So the double distribution trend day will not always look like this. The double distribution trend day could be like this also, and there will be a trend here and a sideways movement here. It might not look alike, but it will have the same characteristics. You have to think what causes a narrow initial balance, what causes a wide initial balance, why are buyers strong at the place where they are strong, why are sellers strong at place where they can push the price lower, why have they pushed the price lower, and why have buyers come in here, and how does the market go sideways here. All these questions are the questions that you will get answered once you start observing price action on those days, or those days that are applicable, I should say. Okay, now the range bound day. So this is a day in which the market will tend to stay in a particular range where the price has already set the range, or the buyers and sellers have already set the range in the initial 1 hour itself. Can you see this now? This is the first 1 hour low, and you can see 1 2 3 4 5 6 7 8 9 10 11 and 12. This was the first 1 hour high. Within the first 1 hour high and low, price has tended to stay throughout the day, and this day ended here, or price would have gone up and hit the IBH also. You can see how close the IBH is to this particular close of price, but that is also because the day itself ended here. Okay, so now what happens here is the price opens with some sort of energy, and here the bulls have taken the price up, but here the market starts to sell off because sellers suddenly come into action here, and the sellers start to push the price down, and then the bulls again become active. You can see the bullish pin bar or the hammer candle here, and suddenly the red candles turn into greens and the market starts to float higher again, and then it tends to go towards the, or tends to get attracted towards the higher side of the market. Here buyers and sellers are equally strong, and this is more like a tennis match. So buyers and sellers will keep knocking the ball from one side to the other. Opponents will keep knocking the ball from one side to the other. Buyers will keep exchanging their trades with the sellers throughout the day. On a range bound day, you can see patterns like the double top and the double bottom pattern. And now we will come to the sixth type of day. This is the last type of day, which is called the sideways day. Now on a sideways day, you will typically see a narrow to moderate initial balance. You will not see a wide initial balance. This is the initial balance high and the initial balance low. And you can see that price has traded right within that range throughout the entire day without really bothering to break it on either side. So the difference between the range bound day and the sideways day is that you will not be able to see any trend here. Such type of days are really boring for the traders, and most often you just spend the day sitting around doing nothing on such days. So price action will not really show you any sort of buying or selling strength on this day. Such days will happen most often prior to a trend day. So these are called consolidation days, where the price is just taking a break. Buyers and sellers are both taking a break. They're not really applying too much energy. The next day, whichever side the price tends to break, the market will tend to break out on that side. So if you can see here, if the market tends to break here or this level on the next day, then violation of this or this level will create most likely a trending day towards that side, because a lot of sellers are sitting short on this market on this type of day, and a lot of buyers are long on this type of day. So whichever side the price breaks out, that side will tend to cover their positions very quickly, and that will lead to a big rally or a big crash on the subsequent day. And that is how you will be able to tap those kind of trades if you're a breakout trader. So guys, that is all for this video, the types of trading days. I hope I was successful in making you understand. Now it is your job to go ahead and watch on the charts, try to study the charts, try to apply the principles I told you in this video. Try to watch this video again if you haven't understood any concepts out of this video, but I'm sure if you take away the understanding of what types of days that you will be able to see, then nothing will be able to beat you as far as the trading choices are concerned. Obviously, there are many other things to consider before trading, but identification of this phenomenon of what type of day this might be, that forecasting ability is a very important ability. So for instance, if you are looking to go long on one side and you think that the market is going to run away to one side, but then you see that there is a wide CPR, the wide CPR suggests that there might not be a trending day. So I just told you that the trending day as well as one other type of day will have a wide initial balance. Just think for a couple of seconds before I give you the answer what type of day I told you will have a wide initial balance, and the answer is the range bound day. The range bound day will also share a wide initial balance along with the trending day. So you will easily be able to catch that day. So if the previous day has had a trend, then the likelihood of the market trending towards that same side today again in indices is very less. The day might be a trading range day today, and it might have a trend, but it will be within the initial balance itself, within the first 1 hour high and low itself. So instead of taking long position again in the market due to the fear of missing out, you might be able to wait for the market to return back to the initial balance low, from where you can take a long trade today if your initial bias on the market is long. And how to establish the initial bias and how to understand which way the market will trade, I have explained in previous videos, so please go ahead and watch those videos. If you like this video, then please let me know in the comment section below. It really helps to boost my morale and keep making such important videos for you. If you've liked this video, please hit the like button, subscribe and hit the bell icon, and also please share this channel and comment in the comment section below. Thanks guys, I'll catch you in the next one. Bye bye.